Rates were at 5.5%, inflation was at 2.5%. I mean, that's 300 basis points of tight interest rates. That's crazy. Mm-hmm. Look at people's mortgages. Look at car purchases. Nobody could get access to credit. Look at credit card rates. It was too restrictive for the economy. Mm-hmm. And they need to cut it because they also need to roll their interest payments and they need to refi their debts at lower rates. So I think we've got 6 years to make as much money as we possibly can. So then we can go into that period of uncertainty feeling secure.
Raoul Pal begins by addressing the common fear that the inflation of the 1970s could return to haunt the global economy. He dismisses this notion, arguing that structural forces such as aging populations, low productivity growth, and high debt levels make sustained inflation nearly impossible. He points out that countries like Japan, China, and Europe have struggled to generate inflation for years, even as central banks have pursued aggressive monetary policies. Pal emphasizes that the current high interest rates are unsustainable and are already proving too restrictive for the economy. With inflation under control, he argues that rates should come down to more manageable levels, around 2% to 2.5%, which aligns with the U.S. economy's long-term growth trend. He notes that elevated rates are particularly harmful to housing markets and credit availability, with higher mortgage and credit card rates stifling consumer spending.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
The US bond market can't completely fall apart. Why? Because you can print money and buy it. So that doesn't happen. The currency could weaken, but the rest of the world is even worse. So I'm not sure where this inflation, this mystical, magical, long-term structural, the 70s are coming back, when you've got an aging population, you've got low productivity, and you've got an accelerated technological revolution, including AI, plus high debts. It's almost impossible to generate sustained inflation, which is why China can't generate it, Japan can't generate it, Europe can't generate it, and the US can't generate it either. Rates were at 5.5%, inflation was at 2.5%. I mean, that's 300 basis points of tight interest rates. That's crazy. Mm-hmm. Look at people's mortgages. Look at car purchases. Nobody could get access to credit. Look at credit card rates. It was too restrictive for the economy. Mm-hmm. And they need to cut it because they also need to roll their interest payments and they need to refi their debts at lower rates. I think moving rates as high as they did was necessary to stop that pervasive idea that inflation was going to be sticky, because inflation can be a mindset shift. You know, we saw corporations after corporation just raise prices. And what this did was slow all of that down. So, no, I don't think it was a mistake. I don't think a Federal Reserve did a very bad job. Nobody likes going through a rate cycle like that. This is the largest of all of our lifetimes, and so therefore it's pretty ugly. It doesn't feel good. Nobody likes it. Business slows down for everybody. But it worked in terms of getting rid of inflation and any expectations of future inflation. So inflation expectations have collapsed in the US now. Mm-hmm. In fact, where are they today? So 5-year break-evens are at 2% and 1 year are at 90 basis points. So nobody's expecting inflation because the Fed did a good job. Now they need to bring rates lower, and they have to bring it a lot lower. You know, I still think rates come down to 2.5, which is the trend rate of growth of the economy. Is if you see rates coming down, house prices are going to be rising.
Well, there you go. Yeah.
So what you need to think about is what the Treasury are doing now, which is you buy the house now when house prices are still a bit softer. And you say, look, I understand I'll have a variable rate mortgage. I'm going to pay a little bit more for the first 9 months. And then after that, I should be able to finance it at lower rates. So you should benefit from the lower rates as they come, as opposed to fixing, let's say, 2 years. You just go to variable rates because they're coming down, right? And in which case, you'll be able to then at least have a slightly softer housing market. Because if not, if rates are at 2%, where's the housing market? The house you were trying to buy is probably up another 20%. And you're like, Christ, I still can't afford it. Rates have come lower and it's gone up in value. GDP, trend rate of GDP is driven by population growth plus productivity growth plus debt growth. So if you think of the world prior to 2008, debt was growing fast and population was growing reasonably well. And the world was relatively productive because the population was not as old as it is today. But debt growth stopped in 2008. It all became about servicing debt. So debt growth now is just the servicing of old debts and adding to it. But it's not debt growth to print money, to borrow money to build new roads or anything else productive. It's not productive. Population growth in every major country is now in decline. It's shrinking everywhere. The US isn't because it's had a decent immigration rate, which has kept it to have a trend rate of growth of 1.75. Japan, no immigration. What's happened to Japanese GDP? It's like 0.5% trend rate. So it's been the balancing factor, but most countries are now trying to stop immigration, but not even immigration, the population's not reproducing. So nobody's reproducing. So we can predict out what's going to happen to economies into the future. And that is trend rate of GDP just keeps falling. So we've got debts rising because we're just servicing debts on top of servicing debts. We've got population that is aging and shrinking. And productivity, because too many old people, is not there. That's our problem, right? That's the existing problem. The answer is the everything code. Just keep printing money and just keep kicking the can down the road. And over time, you will lower the value of the debt in percentage terms versus GDP. That's the hope. But then something happened. Something happened that was a miracle. AI came, which is the biggest technological event in all of humanity. I think it's the same, or if not larger, than the splitting of the atom. Of all of the human inventions, this is the defining moment of humanity. What AI has done has changed everything, because now knowledge, which was a scarce thing, like you pay for a lawyer, you pay for a doctor, you pay for an accountant, you pay for an expert, has now become infinite and basically free. It's a deflationary nuclear bomb.
Pal introduces the concept of an economic singularity, where AI becomes so advanced that it redefines the very fabric of economies and markets. In a world where AI can replicate human tasks instantly, traditional business models may cease to exist. For example, an AI could design a product, manufacture it, and handle all aspects of its sale and distribution without any human intervention. As a result, Pal questions the relevance of companies, stock markets, and even investment strategies in such a world.
What is AI? Well, it's a human mind, let's say. It's exchangeable for a human mind. A robot, exchangeable for a human body. Amazon already employs almost more robots than humans now, and that'll keep going. So what you've got is infinite humans. Now, so that's the population growth part of the equation. Holy fuck, we've just gone from slowing population growth to, oh my God, in a few years' time, it's going to go infinite. We can see the AI and the robots scaling to billions and billions and billions. If you listen to Elon Musk, all of these people, they're talking about, well, there'll be 1 billion humanoid robots by 2035 or 2040, whatever it's like. People don't understand the impact, the economic impact of infinitely scaling human ability. Then the productivity side. So we're all more productive using AI and stuff like that, but that's not the big game changer to the conversation we were having before. If productivity is the amount of output you get per kilojoule of energy. So, there's two factors there: is becoming more efficient, which is what technology does. But really, electricity prices have been pretty stable for a very long time. But if I'm right that electricity becomes abundant, it's going to collapse in price. Mm-hmm. So if technology falls If electricity costs in 6-8 years' time fall by 50%, that's a 2x multiplier on productivity. If you then add in, because the equation is population plus productivity, if you add in the infinite population growth, now obviously it doesn't go infinite immediately, but it's the rate of change, we're going to have la la land GDP. We can have GDP at some point in the 2030s, global GDP hitting 20% a year, 25% a year. Theoretically, it can go to 100% a year. Just depends how fast we scale the robots and the AI and how cheap we can make energy. Okay, what the fuck does that mean? Because the robots and the AI are making the money. Where did humanity fit in? What happens? And it was Beeple, the NFT artist, who raised just a fantastic question. He's like, Raoul, I'm just thinking this through. What happens if somebody gets AGI and then aims it at the stock market? Surely they just win the whole game. And of course. So in which case, if everybody's got AI, what is a stock market any longer? What is a company? What is a company anymore when AI can have AI agents and build their own? And they're using crypto payment rails to pay each other. What is a company? What is the life of a company when if you build some cool tech product, I just put it into my AI and say, copy this, and it writes the code in a minute or 30 seconds. We can already do a lot of that. I can give it a web design, say, hey, just do this, copy that. So how long do businesses last, startups?
Mm-hmm.
How does it become investable? How can we make money? So I've just said, listen, I don't know. That's an economic singularity, beyond which we do not know. And nobody knows the answer. So I think we've got 6 years to make as much money as we possibly can. So then we can go into that period of uncertainty feeling secure.
Pal warns, may create a scenario where those who control AI systems could dominate financial markets, potentially rendering traditional investment strategies obsolete. He advises that the next 6 years present a critical window for individuals to accumulate wealth before this singularity unfolds, as the world could enter an era of uncertainty where current economic rules no longer apply.
Please like and subscribe my channel.